All right. Good afternoon, everybody, and welcome to this afternoon's fireside chat with no fire, at least not for me here. Uh, I'm Tony DeLatour. I'm a member of CFA Society's Member Planning Council, and I'm thrilled today to be joined by Tim Koller, the lead author of Valuation, Measuring and Managing the Value of Companies. This book, I'm holding an old edition here, but the book is now in its 8th edition, and that's part of the occasion for our discussion today, although it, to me at least, feels topical for a lot of reasons. Just a brief introduction of Tim here. He's a partner at McKinsey & Company's Denver office, where he leads the Strategy and Corporate Finance Insights team. Which provides insight to companies and their corporate finance departments and capital market analysis. Tim obviously keeps a grueling pace of work even after 40 years of consulting, as evidenced by his willingness to join us today from a faraway country in a far ahead time zone. So Tim, thanks so much for doing this. A quick couple words about the book here for those who may not be familiar with it. As I said, the book Valuation is now in its 8th edition, and it is literally required reading for aspiring business executives since it's used as a textbook at Wharton, the University of Chicago, and other top business schools. But the authors, Tim and Mark Gahart and David Wessels, are quick to point out in the book's opening pages that it is no coffee table tome. They specifically designed the book as a practical guide for corporate leaders, consultants, and investors, of course, drawing on McKinsey's extensive work with corporations to make the formulas and the theory that they discuss come alive with real-world examples. And that was something that I really enjoyed when going through the book myself. The timing of the latest edition seems topical, as does our discussion today. For a lot of reasons. I think there's many people in the investment community where I and probably many of us work about how to value companies, or as Tim puts it in Valuation, how to capitalize the future value of improvement. And I think reassuringly, Tim, you and your co-authors come to the conclusion that the core principles of valuation still apply. Today the same way they did in the past when you published past editions of the book. And maybe, if you don't mind, we can start there. You published the first edition in 1990, which was pre-Internet 1.0. It was pre-9/11, pre-Great Recession, pre-zero interest rate policy, pre-COVID. I imagine it was before some of the people on this webinar were born. How has valuation and the way you approach it changed over those years?
Well, thanks, Tony. It's great to be here. That's typically the way I like to start the conversation with that question, because we find that the approach that we take to valuation hasn't changed really at all in these 35 years. We obviously have to take into consideration what's going on in the world. But the fundamental principle that a company's value and value creation is ultimately driven by the cash flows that it can generate, and the cash flows are in turn driven mathematically, not just conceptually, mathematically, by company's revenue growth and its return on capital. That's the framework that we have been using. We didn't invent those concepts, we just codified them. That's the first thing I do when I look at a company, as I look at, how fast are the revenue growing, what is the return on capital, historically, what it might be going forward. So those things haven't changed any. I think the other thing I think that's also important that we've focused on over this period of time, we continue to focus on, is what also matters is our definition of value creation is creating value for not just the current shareholders, but also the future shareholders of the company, whether it's a public company or a private company. There are things that companies can do to bump up the share price in the short term that may have a negative effect over the longer term, which we don't think makes a lot of sense. We think companies should focus on the longer term investors. So, the core things to take away are the idea that return on capital and growth are what drives value, and that companies should think about those things from a long-term perspective, making sure to, as long as they're earning an attractive return on capital, making sure they're willing to make the investments to grow at the same time. So those principles haven't changed any. Probably worth talking about sort of, as you mentioned, a lot of things have happened, right? Dot-com bubble, financial crisis, zero interest rates, and now we have the phenomenon of the mega seven companies driving the S&P 500 index, right? So therefore, a lot of people sort of ask the question, or the press often comments on how the market is valued, right? And they're usually talking about something like the S&P 500, and they're talking about how high it's valued, et cetera. We think it's worth pointing out that if you take out the seven companies, the mega seven companies from the S&P 500 index, and look at the valuations of the other 493 companies are pretty much what they have been under, over the last 60 years, right? If you look at the median PE ratio, for example, which it just as a shorthand for sort of seeing if valuations have changed, it really hasn't changed in the last 60 years. It's 16 or 17 times, which ties nicely. We build models of the market to try to understand that, which ties nicely to the growth of profits in the economy and to the sort of median returns on capital for companies. So it all fits together still. But what we have learned, what we've learned over the last 35 years, I'd say, is that bubbles do occur, right? And I don't know whether we're in a bubble right now in those seven companies, but I think we've learned about the dynamics of it. So when I came out of business school in 1981 from the University of Chicago, I thought the markets were sort of infallible, right? But in business school, there's a lot of assumptions made about liquidity and information, but mostly about liquidity, that don't hold true in practice. And so what we're seeing right now, and what sort of leads me to bring up the issue of these seven companies, is the interesting fact is that while most companies' share prices are driven by sophisticated institutional investors, these seven companies, their share prices tend to be driven more by retail investors. If you look at the ownership of the seven companies, the ownership share by retail investors is about twice what the typical company in the S&P 500 is. So what that tells us is that it's retail investors who are buying the shares for the most part. Retail investors typically don't do a lot of analysis, right? They buy because they think a company is a great company, whereas a sophisticated investor says there's two things that matter. Is it a good company? Is it going to generate attractive cash flows? And also, what's the price I have to pay to get in, right? Retail investors often forget that second part. So they just think this is a great company, exciting company. They're willing to buy it. They think other people will buy it. That then leads to professional traders, momentum traders, who also they don't care about the value of the company. They just think that if market sentiment's going to keep pushing it up, they feel that they are quick enough that they can, if they buy in, even if it's overvalued, if it keeps going up, they'll be the ones to get out quickly enough if it turns down. So they'll still make money. They can get out a lot faster than the retail investors can. And then recently, a third element came to my attention. I was talking to some investors. A number of large institutional investors, pension funds, feel that they have to own these seven companies in their portfolios, or they'll look foolish, right? So they're buying as well, even though they may not understand the valuations or be able to figure out these valuations. So you have all these forces pushing up the prices of these companies, and nothing to counter that. Short selling is very risky, very expensive, and just the magnitude of these companies is such that it would be difficult to imagine enough short selling to make a difference. So whether or not these companies are overvalued or not, whether they'll come down, I don't know. Some of them may be, some of them may not be. But the point is that they're being driven, the share prices are being driven by a different dynamic than the other 493 companies in the index for the most part. So I think that's an important thing to keep in mind. The same thing you could observe during the dot-com bubble. It's always important to dig deeper below the surface numbers of the indices and other things like that to really understand what's going on in the market.
Yeah, no, I think in the book you refer to the noise traders that are not necessarily irrational, but not also maybe not paying attention to intrinsic value.
That's right.
Well, and you did kind of front run my next question a little bit.
I'm sorry about that.
No, I think in a good way, because yeah, in the book you specifically reference the '90s dot-com era, and I think there's even a great quotation where you reference companies that made these big investments, kind of thinking that there was a winner-take-all dynamic in force, and they just had to spend freely and worry about a good business model later. And of course, it's hard to read that and not think about the Mag 7 and some of the big AI investments that are happening today. And so you sort of answered this question, but I'll maybe ask it more pointedly. On what side of the argument about today's stock market do you fall? Do you find the argument convincing that companies should be worth more today, even these 7 companies that are skewing it, or not? Or are you more like, I think Howard Marks is fairly skeptical and of what's going on, and or maybe there's just a better question to ask.
Well, I think the question is, will innovation, different types of AI, who will be the beneficiaries, right, of that? And historically, the beneficiaries of most innovation has been the consumers or the customers. And so, and you can sort of imagine the same thing happening today because of competition. So if you look at AI and you look at different types of companies, there are companies that will simply be users of AI, right? There'll be a retailer who does a better job of customer service, who does a better job of figuring out the assortment that they want to put on the shelves or online. They'll do a better job of ordering and inventory management, these things like that, perhaps with AI. But everyone in the industry is going to be using the same AI tools, right? And so it's more likely that will not necessarily lead to higher profits because competition tends to drive down the profits, right? Back to some sort of stable level. And that's been the case, with most innovations over the years, right? If you look at in the banking world, first we had ATMs in the 80s, and it's not like ATMs created more, it was great for the consumer, but the banks didn't create any more value because if you didn't have an ATM, people would not, open up an account at your bank. Then we had internet banking in the early 2000s, and now we have mobile banking, right? It's become the price of doing business, adopting new technologies and using them. But typically, most of the benefit goes to the consumer. So for the vast majority of companies who make, a product, a consumer product, or provide a service, or a manufacturing company that sells pipes or chemicals or whatever, the benefits of the new technologies will most likely accrue to their customers, who will then pass it on to the end consumers for the most part. Then there are companies that will be providing the infrastructure for AI. That's a new industry, and they probably will benefit, right? We don't know how big their returns on capital will be, but we're going to need more. We'll have data center operators. We'll have people who build the data centers. We'll have electrical suppliers, air conditioning companies, et cetera. All these companies will benefit from additional demand. So there could be some additional profits in that sector. And then the other part of the equation is the companies that are designing the AI software themselves. And there we don't really know yet, right? We don't know what the model is going to be. How much will consumers be willing to pay for AI software? How much companies will be willing to pay? What the business models will be like? So that part is pretty open-ended right now. But I think it's important to keep in mind that while there is uncertainty and that could be a big number, the vast majority of companies will continue to operate in a competitive environment as they always have. So I don't expect valuations of the bulk of companies to change very much. There may be an emergence of companies doing things that are unique, difficult to copy, that create a moat around their business. Usually there's only a handful of those companies that can do that at any time though. So it doesn't affect the vast majority of companies.
Yeah, and you talk about some of these digital performance initiatives, and in that same discussion later in the book, there's the talk of digital businesses themselves. And there's one question here that from one of our audience members that very much is in line with one I was going to ask you, and it was, how do you, or what valuation tools do you use, especially with these digital businesses, to put a number on companies or put a value on them where their cash flows or where most of their value is far in the future. And I think there's some great discussion about that in the book. And since I don't work in private equity myself, some of it was new to me. And so I wondered if maybe you can outline some of those tools that cut through the hype with these digital businesses.
Sure. Well, we think it still boils down to revenues and return on capital, except that instead of starting today and forecasting forward, we don't have anything to start with today, right? So what we do is we look forward to 5, 10, or more like 10 or 15 years down the road, and we look at what might that company's business model be like.
Right.
We look at how competitive that industry it's going to be, the market that it's in, and then therefore what kind of margins, what kind of returns on capital might be reasonable, what kind of market share might a company be able to achieve. Is this going to be an industry with 10 or 20 players, or is it going to be an industry with 3 players, right? And that'll also, by the way, lead to the dynamics in terms of margins. And then what we can do is we can extrapolate backwards to today to estimate the value. So we're still using discounted cash flows based on return on capital and revenues or revenue growth, but we're starting from the future instead and working our way back. The one thing we know for sure that we're going to be wrong though, right? Because no one can predict these numbers, right? And so that's why while we think we can often do a good job of understanding, is this the kind of industry that's going to have a 10% return on capital, a 20% or a 30% return on capital? There is a ton of uncertainties, which is why we always develop scenarios, right? And so we like to look at the value of different scenarios. We try to avoid putting a single number on a company, because we're usually working for managers whose job is to sort of think about how to maximize the value, how to increase the value. So the absolute number is not as important than understanding the scenarios and what do I have to do to make those, the better scenarios come home, right? If I'm an investor, what I can do also though is to adapt this a little bit and use, we try the what do you have to believe approach, right? So you can look at the valuation of a company and say, what would you have to believe that company will look like in 10 years in terms of revenues and returns on capital in order to justify today's value, right? And that's a useful exercise. Then we can translate that into, what kind of volumes, at what prices it would have to sell, what would the competitive landscape have to be, So you can come to a judgment as to whether or not you believe that the company seems to be, reasonably valued, way overvalued, way undervalued. Rather than trying to put a number on it, the what do you have to believe approach can be very useful, I think, to investors. And um, I think you can look to history. You can say, okay, you take something like semiconductors, right? Um, you know, historic, are we in a situation where there will be a dominant semiconductor company, or will the industry be fragmented and competitive like it has been in the past, right? Or were there periods where one company dominates for a period, maybe even as long as 10 or 15 years, and then loses its dominance, right? So we can begin to ask those questions about the economics of an industry to make to get some insights as to whether that company is reasonably valued or not in light of what could happen in the future.
Yeah, that's very much in line with what I was reading too, and hopefully that answered the question of the person asking it. There was an interesting part of the book too about customer-based discounted cash flows, which separates out corporate overhead so that if there's a negative earnings number at the beginning, it's still something where you can value the company. And I think one of the most useful things about the book was your constant willingness to decompose formulas and ways of looking at things into their principal parts. And one that struck me fairly early on was uh, the one of the main value driver you already pointed out, return on capital and revenue growth. One channel for creating value is not necessarily better than the other. You're quick to point that out in the book, but it's harder for companies to sustain high revenue growth than high return on capital. Why is that?
Um, that's a good question. Companies that have high returns on capital, usually for, if you've had a company that has a high return on capital for, for the last 5 or 10 years, you could typically trace the source of that high return on capital to something like brands. Okay, so they have strong brands. Brands tend to be very long lasting. People pay premium for brands. When you go to the grocery store, you buy the same laundry detergent every time, right? And if you don't, your family will probably notice that the laundry smells different and say something about it, right? So people tend to, drinks or other kinds of things. People tend to develop a loyalty to brands. So it's logical that brands can earn a high return on capital for a very long period of time. Companies that have patents, pharmaceutical companies, they can earn a high return on capital because their innovation is protected, right? Or companies that have some kind of unique process which is hard to duplicate, or you have a company which is at the low end of the cost curve, right? So those can last for a fairly long time. Revenue, on the other hand, revenue growth, I should say. There's a couple things that happen. One is, the biggest thing is that industries themselves mature, right? So, if you've got a fast growing industry and you're growing with that industry, the growth of that industry will eventually slow down, right? It always happens as consumption of that product sort of reaches sort of a mature level relative to the number of customers that are out there, right? The economy, the number of people out there to consume something is growing at a fairly slow rate, right? So once you reach a certain level of penetration and that flattens out, you're going to see that revenue growth is going to always slow. And we have a chart in the book with and you can see the flattening out of the growth of different products that were new at one point that had explosive growth that eventually slowed down. That's one thing. Secondly, we find that, once again, going back to competition, right? Competition makes it difficult to grow faster than the industry. So as an industry matures or as a product market matures, competition makes it hard for you to grow faster than that. So eventually if you're growing faster right now than your competition, They're working hard to take back that share from you typically, and that competition works to reduce the revenue growth, even if you're both disciplined enough to try to maintain your margins and your return on capital. So empirically, we see that revenue growth does tend to be more stable. I mean, excuse me, return on capital does tend to be more long-term, more stable, and revenue growth tends to revert to a mean because of those factors.
Got it. Got it. Yeah, I'm. What you said there about the growth of an industry reminded me. I think one of your McKinsey colleagues wrote something along the lines of, "It's better to work in a great industry than for a great company."
That's, there are some industries that just don't create value. They're mature and they're competitive, so the returns on capital are low and the growth is low. And there are some industries where everyone, is sort of riding along with the tailwinds and benefiting from it. Even the companies that aren't the best in the industry are getting the benefit of the tailwinds of the industry.
Right. Right. Well, and then this, I guess, returns a little bit to your earlier points about how the stock market views companies, but there's a really interesting cash flow hierarchy, I think, toward the end of the book, and there's a great diagram, and I found that it basically outlines what actions a company can take that will create the most value and the least.
Mm-hmm.
And some of them
Mm-hmm.
I found a little counterintuitive, where doing an acquisition, which is often viewed as sometimes as management hubris, can potentially create a good amount of value, while dividends, which are traditionally, I think, viewed as a sign of management discipline, are mere residuals and don't create much value. Maybe you can talk about what accounts for the difference in potential there.
Yeah. So we use this hierarchy to help clients who struggle with how much should I invest versus how much should I return to shareholders? Because too many companies start, say, oh, I've been repurchasing shares, so I have to still do that, right? Or should I start repurchasing shares or whatever? And there's a lot of pressure to do it. So we create a hierarchy that sort of says what's the best way to create value. So typically organic growth creates the most value because that usually comes at a higher return on capital. Secondly is, and we specifically didn't say M&A, we said value creating M&A, right? So it's important to be specific about that. So M&A investments that earn an attractive return on capital is typically the next priority, because they don't typically earn as much of a return on capital as organic growth, right? Then we talk about getting your capital structure right, because you want a capital structure, debt and equity, that allows you to run the business without too many constraints. And then if you look at it over a 3 to 5 year period going forward, you can estimate how much cash flow do I have left over to return to shareholders, right? And I think that, that's just, in a way, a numerical framework, right? But the fundamental question is, right, how many value creating investment opportunities does a company have, right? And the framework doesn't answer that question. That's the hard part, right? But we can say that if you do have value creating investment opportunities, organic or inorganic, right? And you pass those up to do share repurchases, those investment opportunities will probably not be there a year or two from now. They'll go away. Somebody else will have done them, right? So one thing you don't want to do is to pass up good investment opportunities in order to pay back your shareholders. On the other hand, if you don't have good investment opportunities, then you should be giving that money back to the shareholders. But share repurchases and dividends don't create value themselves, right? Because that would be double counting, right? You can't create value by generating the cash flows and then you double account returning the cash to shareholders, right? Yeah. As you pointed out, though, a lot of the sophisticated investors, they don't necessarily care about a dividend or a share repurchase. What they care about is the discipline, right? They want to know that the company is not making investments that aren't going to earn an attractive return on capital, right? And there are companies that most share repurchases are done by companies that have very high returns on capital. And as a result, they generate a lot of cash flow, and they can't necessarily invest all that cash flow back into the business. So if you take a company that's got, you know, a 40 or 50% return on capital, and even if they're growing at 5% a year, they only need to reinvest about 10% of their profits to achieve that 5% growth, the way the math works.
Right.
And so they're going to end up returning 90% of it to the shareholders. It's a neutral decision. Just like, what else are they going to do with the money, right? Now, on the other hand, if they use that money to make value destroying acquisitions, right, that would, instead of a share repurchase, that would, you know, reduce the value of the company. So it's not that the share repurchases are creating value. They might be helping you avoid the destruction of value. I think that's an important distinction. We also find that most companies, larger companies, don't do a very good job of timing the share repurchases. Sometimes companies say, well, we want to repurchase shares because we think they're undervalued. By the way, every company thinks that their shares are undervalued, right? Not every company, but
I'm sure.
most, even in private, which is sort of surprising, right? You would think that in private, you know, some of them might be more realistic, but a lot of companies complain about their valuations. We usually find that the valuations are usually reasonable in light of their performance. But we find also that, you know, the timing of share repurchases by large companies, there's no evidence that they're actually, on average, good at that. That doesn't mean that individual companies aren't, but on average, large companies are not good. They tend to buy when times are good and prices are high, and not buy when times are not good, right? So, which is the opposite of what you'd be doing if you wanted to buy your shares back at cheap prices.
Right. Right. Yeah. Well, and I've I had a question here about your book's second big thesis, but we also have a couple questions about discount rates and the appropriate discount rates to use. And so I wonder if maybe you could fold in your discussion of capital costs, how it's misunderstood maybe, with what discount rates you use, because of course, as people in the audience are pointing out, your valuations can be quite sensitive to that.
Yeah. Yeah. A couple of thoughts on that. One is, first of all, you know, we don't, you know, despite all the academic theory, you know, measuring return cost of capital is there's no precision there, right? You know, I can't tell you whether it's, you know, 7.5 or 7.75 or whatever. So whenever I see cost of capital as being, you know, 8.26%, you know, that's kind of ridiculous, right? And that's just the reality of it, is we don't really know what particularly the cost of equity is. Much easier to estimate the cost of debt. But we do know a couple of things. One is that, first of all, most companies you don't really have any control over your cost of equity. That's important, right?
Yeah.
Your cost of equity is a function of the industry you're in. We use the capital asset pricing model like most people, in terms of, you know, thinking about the riskiness and adjusting for riskiness. One of the things that we perhaps do that is different than some, though, and we've learned this from experience, is you think about what is the cost of equity for the typical company in the market, let's say with a beta of 1, if you want to get technical about it, right? And what we found, we started doing this about 20, 25 years ago, where we started to reverse engineer and say, given the level of prices in the market for the median company, and given, you know, returns on capital for those companies and profit growth rates, what's the implied cost of equity? And what we found was that the implied cost of equity in real terms, not nominal terms, is about 7%. And that's pretty consistent going back 60 years. So just as a rule of thumb, if you say 7%, you know, real cost of equity, and 2% inflation or so, you would say 2.5. You'd say cost of equity for the typical company 9.5% in the U.S. in U.S. dollars, right? And what's interesting though is we find that during the period, one of the reasons why this is important is because during the period of close to zero interest rates, right, we found that when we took this approach of inferring the cost of equity from prices, we found the cost of equity didn't change any. Okay, so equity investors did not reduce the cost of equity when the central banks reduced the cost of government debt, right? So what we were seeing, one way to think about it is the theory says that the cost of equity should be based on the risk-free rate, a market risk-free rate. So we typically have used government bond rates as the market, but the markets was being manipulated by the central banks, right, and being artificially forced down. And equity investors, I think, realized this, right, and anticipated that interest rates would eventually go back up to something more normal, right, which took a lot longer than most people expected, but eventually did happen, right? And if you look at economists' forecasts, both Federal Reserve as well, the forecasts going, back in 2012, 2015, was always that interest rates would go back to sort of long-term interest rates go back to 4 or 5% kind of thing. And I think equity investors took that into consideration. And, as an equity investor, you're investing in an asset with long-term cash flows, like a company, right? If you say, okay, I'm going to believe that the cost of equity is now 6% instead of 9%, right? But then tomorrow interest rates goes up, I'm going to lose a lot of money. So equity investors aren't going to do that, right? And one way to think about it is, or one way empirically to see that that's exactly what happened is during this period of low interest rates, the typical price earnings ratio stayed in the range of 16 or so, somewhere 16 to 17 or 15 to 17. And if in fact the cost of equity had gone down a lot during that period of time, you should have seen price earnings ratios above 25 for the typical company. And that did not happen, right? So, it's interesting that equity investors maintained the cost of equity during, even while the government was trying to push down interest rates on government debt, the equity investors were not fooled by that would be sustainable.
Yeah. Oh, yeah. Very, very interesting. Yeah, and I think you said that the correct risk-free rate was not what treasuries were. It was something on the order of 4%, right?
Yeah. There are two approaches to sort of, one approach is to say, if I know that, the average cost of equity is 9% or something, and I got to divide that up between the risk-free rate and the market risk premium. One approach is to, what a lot of banks assumed at the time was that the risk-free rate had gone down, but the risk premium had gone up, and that's why the cost of equity stayed the same. Yeah, our approach was to say what's probably happening is that investors are thinking about what a very long-term what a long-term risk-free rate might be. And so what we did is we said, okay, if you look at it historically, the risk-free rate had been around, in real terms, had been around 2%. So add 2% inflation, you get a 4% nominal rate kind of thing, or 4.5%, whatever. So that's the approach that we've taken. Either way, you roughly get to the same number for the most part, depending upon which approach you take. We think our approach is a little bit better because if you believe that the cost of the risk-free rate had gone down and the market risk premium had gone up, you would expect to see a bigger dispersion between high risk and low risk companies, and that didn't happen. So that's why we've taken the approach that we've taken. I think pragmatic, but also grounded in sort of some logical thinking.
Yeah. Well, and speaking of risk, I think our next thought kind of takes that to a company decision level where there is, I think, the conclusion in the book that a lot of corporate leaders don't take enough risk, maybe because of miscalculation of the cost of capital, like you said. I mean, I guess the question is, does the loss aversion you discuss in the book, does that explain that? Or is it just another example of the short-termism you continue to encounter?
I think it's a little bit of both. Okay, so um, we've been working, in the new field of behavioral economics, right? We're relative. It's not that new, but it's been, it's being more codified now. And what pioneers like Daniel Kahneman have shown is that people are loss averse. Okay, they weight losses more than gains, right? And that afflicts companies as well. Okay. And so if you look at an investment project, and let's suppose that it has a expected value of 50 and an upside of 125 and a downside of minus 25, people tend to weight the downside more than the upside. And they therefore might pass up that kind of an investment opportunity. They pass up investment opportunities with wide dispersions of results. We've seen that. And the problem is that they're looking at it in isolation, right? It looks risky, but what we wrote an article and we talk about in the book, the article in Harvard Business Review called "Your Company is Too Risk Averse." The thing we point out is, as a company, right? What matters is not the riskiness of an individual project, but the riskiness of your portfolio of projects, right? And if you take that risky project, right, and you look at the contribution to the risk of the portfolio, if you have 30 projects, it's actually quite small, right? So it helps you to get comfortable taking on more risk. So one thing that we think is important to overcome loss aversion is to look at sort of risk in the context of the portfolio, not as an individual project, right? So you want to maximize the value of the portfolio projects at a given level of risk, not each individual project. So that allows you to take on more projects. The other thing you also have to do, though, is you also have to make people comfortable taking on those risky projects inside the company, right? Because the managers are risk averse or loss averse as well. And one concept that we came across that we like is the concept of that articulated by Jeff Bezos. He distinguishes between experimental failure and operational failure or executional failure, right? And I find that interesting because when you think about, you want to make sure that you're not penalizing executives who are taking on risky projects for experimental failure. Experimental failure is usually something that, the CEO may agree, we're going to try out this new product. Customers don't react the way we hope they would, or some external event occurs. We're not going to penalize the executive responsible for the project. On the other hand, if the executive doesn't do a very good job, they don't bring the they don't manage the project well enough to bring the product to market, quick enough, maybe they do get penalized. So we try to make it so that a company doesn't overly penalize people whose projects don't work out. Try to figure out why the project didn't work out. And also another thing that I think we think is interesting is rewarding people who kill their own projects. You figure out early on that your project's not going to succeed. One of the things we know for sure, and I talk to audiences of corporate executives all the time, and I ask them, how many of you, kill projects or fast enough, right? And almost no one ever raises their hands, right? Everyone acknowledges that they're slow to kill projects, right? One way to fix that is to not penalize people who come forward and say, hey, this is not going to work out. We'll save the company money if we stop the project. We can put that money to work somewhere else, some other investment. So there's some things you can do to overcome that loss aversion, both from a portfolio perspective and from an individual executive perspective.
Oh, yeah, very interesting. And so I realize we're bumping up against the time here, and I think you've done a great job addressing some of the questions that come in, and so maybe I'll just ask one more here, kind of an extension of what you just said, which is that when we talked before, you said that despite increasing awareness of return on capital as a key component of value creation, and presume at 8 editions of this book and other academic work talking about the dangers of short-term thinking, it is somehow persistent, and short-term thinking amongst high-functioning corporate leaders is somehow entrenched. Why do you think that is? And beyond maybe what you just said, what's the fix?
Well, I feel pretty confident that that goes on because I see it all the time in companies, right? Recently saw a company that spun out one of its business units into a separate public company. And under the ownership of the parent company, it had been growing its revenues 1% a year when the market was growing at 5% a year, right? Because the company was not letting the business unit invest in innovation. They were focused more on increasing margins, right? And we see this a lot. We see when companies break up, in the separate independent companies, they tend to grow faster because as you see big companies, they tend to use very blunt instruments, right? They say, okay, everybody has to cut costs, everybody has to increase their margins. By the way, whenever I hear somebody and a CEO say, we're going to increase our profits faster than our revenues, I get nervous. And part of the problem is that they're also not managing the business granularly enough, right?
Yeah.
And they impose that across the entire organization when there are probably some business units that should be focusing on growth and some that should be focusing on improving their margins and their return on capital. I think that part of the problem is that a couple of things. One is CEOs need to be more granular in the way they understand the performance of the units, the way they set the direction for the units, not at a corporate level. That's useless, right? Not even at a division level. You got to go down to the level of 30 to 50 or sometimes more units and really tailor what each unit should be trying to do. And if you don't have time for that, you've got too complex of a company, right? CEOs need to spend more time on that strategic direction for each unit at a granular level and resource allocation to go along with it, making sure that resources are dedicated to where the opportunities are, not necessarily to the biggest businesses. One solution also is to make sure that you have rigorous processes that force you to reallocate resources from low to high opportunities, not just because, typically we give more resources to bigger units, and we also pay the executives who run the bigger units more, even though that may not be where the future opportunities are. So we've got it all backwards, right? That's one thing. The other thing is that CEOs, I think, a lot of their compensation is still driven by short-term financial results, right?
Yeah.
And so that creates that creates a problem. I think boards of directors should move away from any kind of thing that you can measure easily, almost by definition is short-term, right? Or any kind of financial metric, right? And so I think boards need to spend more time evaluating the performance of the CEOs more holistically, thinking not just about the financial results, but how did they achieve the financial results? Did they achieve the revenue growth or just the bottom line? Did the CEO make the investments they said they were going to make? And are they making progress in having those investments pay off? Those are the kinds of questions. I think boards can do a lot better job of making sure that the CEO is more long-term oriented. I also think part of it also is that boards and CEOs have misperception about what investors think, right? They listen too much to the loudest investors, who are typically short-term investors, as opposed to the smart long-term investors, right? So they need to sort of almost close their ears to the short-term investors and pay attention and have a dialogue with the long-term investors to give them some courage to be more long-term oriented. So those are some of the things that I think that can be done for companies to be more long-term oriented.
All right. Yeah. Well, thanks so much. That was very interesting, as the book was, and if for what it's worth, I highly recommend it. It helped me a lot, and some of it, I think CFA charter holders, much of it, I think will be familiar to CFA charter holders, but also a ton of wonderful examples and insight to bring some of these concepts to life. So, Tim, any parting thoughts? And I think you said it best, and we can leave it there.
No, I really appreciate your having me on. I enjoyed the conversation. And, just reiterate, maybe the last point that, being short-term oriented usually comes back to, to put you in a bind usually. And we need to learn, companies need to learn that lesson and be more disciplined and be more courageous about the long term.
Yes, sir. All right. Well, thank you so much, and thanks everybody for tuning in. And I think we'll leave it there and have a great rest of the week. And Tim, get some sleep.
Yeah, thank you so much.
All right. Take care.